Today we're going to do, hold on. Ah! That was fun. All right. I am literally left speechless, but I still have a lot to say. We are seeing the worst data ever. The division between Wall Street and Main Street is like nothing we have ever seen. That includes the Great Depression. Data looks bad. Market grinds higher. Who's right? What's our next direction? Lots to talk about. Sit back and let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing, hitting that like button, all those fun things. Speaking of thank you, we actually hit 10,000 subscribers last week to our channel. Kind of overwhelmed by that. Really do enjoy these videos. Hopefully you do as well. Now don't forget, I am a practicing financial advisor. So what I talk about in these videos, this is what I use to make my decisions in my portfolios. I'm not just some talking head on TV. Let's get to today's agenda. First up, the big charts, right? What's going on? Why is this market going higher? Very thin, but we are seeing some sectors break out. Speaking of sectors, how about that sector spotlight? Then, what keeps me up at night? All this awful data that I'm seeing, but at this point has not made a difference, but it will at some point. Wrapping things up, we're going to hit our game plan. So, let's go to the big charts. All right, first up, we're going to start with the charts. Now, part of our process, we've got the charts, which is technical analysis. They show us momentum, trends, etc. Then we have our fundamental analysis, the underlying data, and then our cycles. The other thing when we look at the charts, we have our monthly, long-term, mid-term, short-term, and that's how we set up our portfolios and add or reduce equities based on that. So first up is going to be our long-term view monthly. What do we see? Well, the one positive thing, okay, is that the monthly trend has gone above the 12-month moving average. Not a bad thing. Now, that being said, down here, momentum, right? Whenever we see black over red, that's not good, okay? That's negative momentum. So right now, we stay negative on the long term, and then we look at relative strength that continues to go down. So again, long-term view is negative. Now, we have had a change here. This is our weekly chart, okay? There's a couple things we'll see. Here, right, and I can zoom in, all right, we've had a positive momentum shift, okay? So black over red, trying to keep it simple. That shows a positive stance, okay? We're also at the 40-week moving average. Again, we're right at it. We'll see what happens today. That also is a good sign. So right now, our midterm view is positive. Whether or not I believe in it, that's another story, okay? So next up is our short-term view. So we've talked about this, right? Here we have these lines. If you're new here, that's called the Fibonacci. I'll have a link up here. But it basically shows you retracement areas that you look for to show that this market is going back up. Now, you see this big cluster we were stuck in for about a month, okay? So I was pretty much market neutral at that point. So we actually failed on that 61% Fibonacci, but then we broke out, okay? Most importantly, and I said this in our client video last week, private client video, that's the line in the sand. Well, we broke that, right? We got it right there, and then you get a confirmation. That's what I am looking for from a technical standpoint. So I think that right now, okay, we are positive on the short term as well. What else? I think the big thing is here, there's still a lot of upside. If we get it, okay, right now, as of yesterday's close, about 12% upside. So we've started adding more equities because of this, okay? Because of the long-term view, we still have some extra cash, and we're going to slowly deploy. If this continues up, we will look to continue to add equities. Again, I may not believe that based on jobs and other things we're going to talk about, but this is what the charts are showing us right now. So some of the reasons why I don't believe it, okay? This is your S&P equal weight. Now, keep in mind, the S&P 500 is cap weighted. So here's an image of those companies. The biggest companies, the FANGs. That's what's been driving this market, a very thin market indeed. So your equal weight, 500 companies, they get what? An equal weighting. Everyone has 1/500th, and we're still 17% from its top, okay? And then we look here, this is equal weight relative to the S&P, and you can see it's grossly underperformed, okay? Again, reconfirming that this is really stuck on just a few big names. Now, the broader view, the New York Stock Exchange. So we've gone from 500, the NYSE is 2,800 companies, excuse me. You can see here, okay, we're still almost 21% from its high. So the overall market is still in a bearish trend, okay? The market is not just the S&P, folks. You have to be able to look some other areas, and we talk about this, okay? S&P, mid caps, small caps, and you can see smalls 21%, mid 16%. So we're not seeing that full breadth yet, and we're going to talk about small caps here in a second because again, one part of the market might be going up, one part of the market, okay, to me is grossly overvalued. How about 70? That's right, 70 times earnings. Okay, so smalls, I think, are a better opportunity on the short side than the long side, okay? So now, let's go to Sector Spotlight. All right, first up, healthcare. What do we see here? Obviously, what's going on, right? Now, you also have to look at earnings. Earnings do matter, folks, believe me. Earnings on the first quarter healthcare, one of the few positive spots. So that's one of the reasons we like it, okay? When you look at the overall S&P, we're almost minus 8%. So right now, healthcare kind of trading sideways, almost got that breakout yesterday, but I have a full allocation here right now to healthcare. Staying in healthcare, I have biotech. Now, we like large biotech, not small biotech. Too much volatility in the smalls, but so here you see everything going up. Obviously, a lot of these companies are working on some type of vaccine. Okay, again, almost had the breakout yesterday when we pulled back the other day. That was another entry point for me. So like biotech, not a full allocation, but do like it going forward. So gold, I've talked about gold for some time. It's been one of our top holdings since fourth quarter 2018. We did reduce here, okay, when there was a little bit of a liquidity crisis when all this mess started, okay, but we've been a full allocation ever since. Now, we have consolidated. So why? Well, it's simple. When we're in this cycle, the fourth cycle, you have to follow the treasury. See how it's flattened out? Okay, as the treasury goes, gold goes in the fourth cycle. We still feel it's going to go lower. Okay, we're also in a deflationary right now, so we'd like it in this cycle, and then in the next cycle, we're going to like it as well because gold does well in inflation, which we anticipate coming. The next thing is gold volatility has really come down quite a bit, so another reason why we like it, all right? Consumer staples, obviously, right? We've had a rough time here like everyone else, but it's really has driven itself back up. Consumer staples, got a little bit of upside resistance here. That's your 200-day moving average. So we'll see. Hopefully we can break above that. But I don't quite have a full allocation. I'd say I'm about 70%. We'll add if we break above the 200. So those are all what I'll call longs, right? Looking for them to go up. But in this market, even though the S&P looks good, the NASDAQ looks good, excuse me, there's parts of the market that don't look good at all. Okay, as I've said earlier, small caps are still in a bear, financials. So for me, okay, when you look at the small caps, I think that we've gotten way overbought, as I said, trading at 70 times earning, still 25% from its high. So this is an area that I like to, I hate to say I like to see go down, but we are hedging some bets here to see that go down, okay? So next up, what keeps me up at night? All right, so first up, we go to our market cycles. Right now, we have been in cycle 4. In fact, deep cycle 4. Why? Well, the market, obviously, growth slowing. Yes, minus 8% earnings. Inflation decelerates and deflation. So there are certain asset classes that do well in this, and we talked about that in Sector Spotlight, gold, treasuries, etc. Okay, but what keeps me up at night? U.S. companies have borrowed almost a year's worth of cash in the first 5 months. Holy schmoly. That is not a good sign. And yes, Chris, that is concerning. Okay, so the big story is, as I said in my intro, 40 million reasons why this market should not be going up and this big disconnect we've had. Okay, after yesterday, we are now up to 40 million people unemployed. It's tragic. Okay, now the press, of course, says, oh, the numbers are getting better because last week, it's trending down. Sure, it's trending down, but the overall number continues to trend up. And this is, to me, one of the biggest issues. Now, with all these layoffs, what happens? Look at this spike in personal savings, which is interesting. That will happen, okay, in these type of times. So why? Well, we already know that several million, 5 million people are either in forbearance with their mortgages, 3 million not even paying their mortgages. They're saving to stay afloat, okay? This is the big issue as we go forward, okay? Now, with that, you would expect the GDP to go down because 70% of GDP is the consumer. As we see, they're not spending, all right? Also last month's retail number, but now they've come back. We're at minus 40% GDP projected in the second quarter. That is an unprecedented decline. So with 40 million, higher than the Great Recession of 29, worse than any time in history, and we don't say that very often. So here it is, the federal debt. So what's going on with this federal debt? All right, we are now up to $7 trillion. Now, in the beginning, they put out about $3.5 trillion. $1 trillion went to 3 hedge funds, okay? So the Fed was trying to create liquidity in the market. That's how things flow in the market. If there's no liquidity, things dry up, we have issues. And that's really what started happening back in last October. They started flooding it because there were some cracks in the system. Now there's big cracks because of what's going on. So the Fed continues to pump out money. So liquidity is good, but here's the upcoming problem: solvency. Okay, that liquidity is going to quote unquote Wall Street to keep, the plumbing moving, but solvency is going to be the problem we're going to see this quarter because companies' sales are going down, right? The revenues, everything's going down. Expenses aren't, so then we're going to see more unemployment. The Federal Reserve cannot address the solvency issue that we're about to see, and these are some of my biggest concerns. So when will this end? We've done this before, kind of new, right? So, it's a new paradigm, right? That's at the end of the year, return to normal. I still feel that that's where we are right now. Again, what's your number? Okay, sure, the market has come back. We have 40 million people. I mean, this disconnect between the market and Main Street is beyond anything I've ever seen. It's unfathomable to see this market go up. Now, all that being said, okay, 2 of my signals are positive, so I'm in the market right now, not 100%, but you have to go with the momentum of the market. The fundamentals are just awful, okay? So where are you comfortable? This is a good time, again, to rebalance and take some profits. Find opportunities. Like I said, you don't just go long. There's some short opportunities. The VIX, we didn't talk about that. But even with this market continuing to go up, the volatility indexes stay between 28 and above. That is a huge sign. The future market sees volatility. And of course, you can follow us for updates on Facebook, Twitter. I can communicate there. Can't do it on YouTube. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.